Chapter 1. Risk and Theory of Probability. The concept of risk. In order to understand what is insurance and how it operates, it is necessary to have clear ideas about the meaning of the term risk, its consequences, and the different types of risks. 1. The term risk has several meanings. To the ordinary man in the street, risk means exposure to danger. The dictionary defines risk as hazard, chance of bad consequences, exposure to mischance, etc. However, in a broad sense, it is the exposure to events which cannot be predicted with absolute certainty which is thought of as risk. 2. There is a great deal of uncertainty in life, business, commerce, industry, etc. Firms may suffer loss due to the destruction of their property by fire, flood, cyclone, etc. Further, there are several other uncertainties associated with the conduct of any business. Some examples are production may not reach the planned output, marketing efforts may fail due to lower prices or better products of competitors, business finance may not be easily available or may be costlier. The above examples suggest that the term risk may be defined as future uncertainty as regards financial loss. The risks involved in the above examples fall under two categories: business risks, pure risks. 3. The following chart provides illustrations of business risks. Technical, new technology. Social, consumer behavior, industrial unrest, economic, inflation, tax policy, competition, political, war, nationalization. Some examples of business risks are provided. 4. Production may not achieve the planned output at the planned cost due to uncertain events such as non-availability of raw materials or increase in their costs or labor problems in the form of strikes, or work to rule or go slow tactics, etc. 5. A firm may fail to sell its products at the planned price because of competitors' actions in terms of reduced prices or better products or changes in fashions and consumer tastes and preferences or reduced consumer spending power due to recession, unemployment, etc. Export sales may be affected by war, changes in exchange controls, tariffs, import quotas. 6. Most businesses depend upon credit for financing. Working capital may be affected if bank credit is not easily available or there is increase in market interest rates. Another risk is the failure of debtors to settle their debts. This problem is often encountered in overseas trade where the buyer may be unable to pay because of exchange control regulations or other restrictions by the government of his country. 7. Business risks are also known as speculative risks because their outcome may be a loss or a profit. Under competitive condition, one firm may suffer a loss but another firm may make a profit. 8. Closely related to speculative risks are dynamic risks which arise from the changes that take place in every society, that is, economic, social, technological, environmental and political changes. 9. The characteristics of business risks or speculative risks or dynamic risks are evident in the exposure of individuals or organizations to financial market transactions. 10. Financial market comprises such entities as banks, non-banking finance companies, mutual funds, life and general insurance companies, etc. These institutions provide a mechanism for transfer and pooling of savings and deposits and investment of these resources subject to the parameters of safety, return, liquidity, diversity and capital appreciation. 11. These benefits are exposed to various risk factors such as recession in the economy, fiscal, monetary and credit policy of the government, imprudent management of funds and investment portfolio, increasing bad and doubtful debts, non-performing assets and so on and so forth. 12. Business risks normally benefit society and the economy in the long run, but they are generally considered less predictable because they do not occur with any precise degree of regularity. 13. Business risks are generally uninsurable. These risks produce types of losses for which insurance cover cannot be provided because the insurers do not have sufficient knowledge of the various factors which affect such losses. For example, business risks, i.e., loss of earnings due to the operation of the laws of supply and demand or market fluctuations in prices or increased taxation, etc., cannot be covered under an insurance policy, because the insurers do not have the means to measure the various economic factors which could cause these losses. In other words, it is not possible for insurers to assess the risk involved and fix proper rates of premium. 14. At any rate, if such covers are provided, it would inhibit economic progress as the insured would be tempted to fall back upon the insurance protection rather than make efforts to avoid such losses. These risks have to be avoided or controlled by general management and functional management in the areas of production, marketing, finance, research and development, etc. These risks are managed by strategies and techniques other than insurance. 15. An enterprising businessman or industrialist will invest his capital and accept the various risks that are involved in the enterprise, for he is well aware that without risk there will be no gain. In fact, if risks were avoided, there would have been no progress in any field of human endeavor. Thus, in all economic enterprises, profit is the reward for uncertainty bearing and is responsible for overall economic development. 16. The other techniques are control of business risks at the specific level by functional management. For example, production management may undertake proper planning of production, efficient operation of the plant and equipments, provision for adequate supply of raw materials through buffer stock and alternative sources of supply. Marketing management may conduct extensive market research for their existing or new products. 17. At the macro level, general management may adopt certain strategies to control business risks. Diversification is an important feature of modern economic enterprise. A manufacturer who produces and markets a wide diversity of products is less susceptible to losses than one who concentrates on a single product. 18. Diversification may also be achieved by geographical location. If business is transacted on a worldwide scale, losses in one part of the world may be balanced by profits in other areas. A wholesale merchant who would like to deal with many customers than with a few large ones is adopting the same principle. 19. Risks may also be spread over a larger capital. A sole proprietor may enter into partnership with others so that losses and profits are spread over a wider field. This principle of spreading risks over a larger capital lies at the basis of the modern joint stock company with a large body of shareholders who contribute the capital. 20. This institution permits a large capital to be invested in an enterprise and allows large-scale manufacturing operations with losses spread over a large number of the investing public. The investors, too, are enabled to spread the risks to their capital by investing in different joint stock companies. 21. Risks can not only be spread over a larger capital or a wider area, they can also be spread over a period of time. The adverse effects of the risks incurred as a result of fluctuations in economic conditions, recession following a period of prosperity, may be averaged in time. To achieve this, reserve funds are created out of profits in joint stock companies to be utilized in bad trading conditions. Pure risks. 22. Examples of pure risks are provided as follows in different categories for better understanding. Chemical, fire, explosion. Natural, cyclone, flood, earthquake. Social, riot, strike, theft, fraud, negligence. Technical, machinery breakdown. Personal, death, disablement, sickness. These risks can also be managed through various methods such as avoidance, prevention, etc. Minimization of risks. 23. Risks may be minimized or eliminated through better methods of management, which include such techniques as improvements in plant and equipment and adoption of various loss prevention measures. Avoidance of risks in manufacturing activities may be achieved by a change of process, such as the use of electricity as a source of power instead of steam from a boiler. Loss by fire may be reduced by the provision of sprinklers and fire extinguishing appliances. Industrial accidents resulting in personal injuries may be reduced by safety measures such as fencing of machinery. Damage to goods in transit may be reduced by better methods of packing. All these measures are justified if the cost involved is less than the potential cost of the losses sought to be eliminated. Reduction and elimination of risks is not only in the interest of the particular business enterprise, it is also in the interest of the community, in general, as these losses affect the economic prosperity of the nation. 24. Yet, in spite of all precautions and preventive measures, accidents do occur. A motorcyclist may maintain his vehicle in good condition and drive very carefully and yet may be knocked down by another vehicle whose driver loses control. In spite of no smoking rule, a worker may carelessly throw a lighted cigarette which may cause a fire in a godown. Then there are floods, cyclones, earthquakes, etc., known as acts of God, i.e., events outside human control or intervention. 25. The term pure risk is used to designate those situations where the occurrence of the event results in a loss as distinguished from a speculative risk where the outcome may be a loss or profit. 26. Pure risks are also known as static risks as distinguished from dynamic risks. They occur independently of dynamic risks. Losses by these risks may occur even if there were no changes in the economy. These losses arise from causes other than changes in economy such as perils of nature, human behavior e.g. negligence, dishonesty etc., riots and strikes, etc., fires and explosions, etc. 27. Pure risks or static risks occur with a degree of regularity over a period of time and as a result are generally predictable based on past experience and application of statistical laws and techniques. Note, in the insurance context the term risk has two other meanings. It is used to refer to a peril or loss-producing event e.g., the fire policy covers the risk of fire, explosion etc. It is also used to refer to the subject matter of insurance e.g. a timber-constructed building is a bad risk for fire insurance. 28. Although the problem of pure risk can be minimized to some extent, it cannot be eliminated altogether. Hence, it was found necessary to devise some technique or device or method to deal with pure risk and its financial consequences. Human ingenuity found the answer in the insurance system. 29. There are two basic concepts in the insurance system. transfer or shifting of a risk from an individual to a group, sharing of losses, on some equitable basis, by all members of the group. These concepts may be illustrated with a simple example. Let us say, on the basis of past experience in a small town, on an average, every year 2 out of 1,000 motorcycles become total losses due to accidents. If the value of a motorcycle is, say, Rs 0.50, the total annual loss would be 1 rupee, This loss may be made good out of a fund consisting of contributions of 100 rupees per from each of the 1,000 owners. Thus, under the scheme, an individual transfers his risk of loss to the group and the losses are shared by the group. 30. However, the scheme will have to be managed, that is, contributions have to be collected and losses, as and when they occur, paid. This may involve expenses of, say, Rs 0.10. Further, a few owners may not be aware of the scheme or willing to join it. Therefore, a person may have to approach each such owner and persuade him to join the scheme. His remuneration may be, say, Rs 0.15. This additional expenditure of 25,000 rupees per will have to be paid by all the owners and the individual contribution will be 25 rupees. Further, an enterprising businessman may operate the scheme on a commercial basis for a profit and he may charge 130 rupees per his contribution, which includes his profit of 5 rupees. The individual does not know whether he will suffer a loss or not. Thus, at the individual level there is uncertainty. But the group knows, from past experience, that there may be 2 losses. Thus at the group level there is certainty. 31. Insurance business operates along the same lines. A large number of persons who are exposed to a risk pay a certain amount as premium to a common fund from which fund the losses of a few are paid. The administrative and selling expenses, e.g., agency commission, are also paid out of this fund and any balance goes towards insurers' profits. In the insurance business, the contribution of 100 rupees per is known as the pure premium, which is suitably loaded or increased to provide for expenses, reserves and profits. Thus, the final rate of premium will consist of the following components. Loss payments. Loss expenses, e.g. survey fees. Agency commission, etc. Procuration costs. Expenses of management. Margin for reserves for unexpected heavy losses, e.g., 7 total losses against 2 assumed margin for profits. Thus, the final rate of premium may be 130 rupees per as against the pure premium of 100 rupees per vehicle per year. Note, the figures are hypothetical and are used for illustrative purposes. 32. Thus, insurance may be described as a method or a technique which provides for collection of small amounts of premium from many individuals and firms out of which losses suffered by the few are paid. The individual insured, who is exposed to a large but uncertain loss, is able to buy protection through the payment of a small but definite cost viz. The premium. 33. The legal definition of insurance is that it is a contract between the insurer and the insured whereby, in consideration of payment of premium by the insurer agrees, subject to the terms of the policy, to make good any financial loss the insured may suffer due to any peril insured. The policy, which is a document issued by the insurers, is an evidence of the insurance contract. The basic concepts of transfer of risk and sharing of risks are now elaborated to explain how the insurance system operates in practice in the treatment of pure risks. In the example above, para 29, loss experience of motorcycles indicated 2 total losses. 34. If a similar study of past loss experience is made in respect of motor cars, the results will probably show that out of 1,000 such vehicles, on an average 5 will be total losses. The loss experience in respect of motor vehicles, it will be seen, will vary according to the type of vehicles. 35. Secondly, an examination of past loss experience will also establish that in respect of the same type of vehicle, e.g., motor cars, the experience may vary according to the geographical area in which the vehicles are used, some areas with a greater density of traffic showing greater losses. 36. From the above analysis, 3 broad principles emerge. Firstly, the rate of contribution, i.e., in insurance language the premium, depends upon past experience. Secondly, it varies according to the degree of hazard or exposure to loss or damage of the property concerned. There is a greater likelihood of fire in a building of wooden construction than in a concrete building. Hence, the former is charged higher premium and the latter lesser premium. Goods vehicles are more exposed to accidental loss or damage than private cars. Hence, the former attract higher premium than the latter. Thirdly, classification of various types of property according to the hazards involved, e.g., motor vehicles into private cars, taxis, passenger buses, etc., is necessary to fix the rate of premium on a fair and equitable basis so that the more hazardous property carries a higher rate of premium. Classification of risks. The first principle says that rates of premium depend upon past loss experience. 37. The second principle says that rates of premium should be equitable and fair as between different individual insureds. Strictly speaking, each individual should be charged a premium according to the hazard to which he is exposed. But it is not practicable or feasible to fix separate rates for each individual risk. In order to collect loss experience and interpret it in an intelligent manner, it is necessary to adopt a system of classification of risks so that each class of risk will have a homogeneous character which will facilitate proper assessment of common hazards and reasonable forecast of future losses. 38. Therefore, a system of classification of risks in broad categories is adopted. Each category will comprise homogeneous types, with more or less similar risk exposure. For fire insurance, risks are categorized into dwellings, shops, godowns, manufacturing risks, etc. on the basis of nature of occupancy. Again, within each broad group, there may be further subdivision. For example, godowns are classified according to the type of goods stored, e.g., non-hazardous, hazardous and extra-hazardous. Manufacturing risks are subdivided into chemical industries, distilleries, jute mills, textile mills, match factories, rubber factories, tea factories, etc. Motor vehicles are broadly classified into private cars, two-wheelers, motorcycles and scooters, and commercial vehicles. Private cars are further subdivided according to cubic capacity of the engine. Higher the cubic capacity, more powerful the engine, and higher the accident potential and hence higher premium. Commercial vehicles are further classified into goods carrying vehicles, passenger vehicles, and so on. 39. The principle adopted is to classify the risks and then assess the premium in such a manner that each class of risk is self-supporting, i.e., losses of that class are absorbed by premiums of that class only. Thus, equity is maintained in as much as each individual pays premium strictly in proportion to the hazard of the class to which he belongs. Insurable risks. 40. A risk becomes insurable if it has the following characteristics. A. It must be a pure risk. Speculative and dynamic type of risks are not insurable. There must be a fortuitous or accidental element involved, i.e., something which may occur and not bound to occur. Accidental damage to motor vehicles is insurable but not normal wear and tear, which is bound to occur in all kinds of property. There is nothing fortuitous about wear and tear. Inherent vice is excluded under marine cargo policies. It refers to natural or inevitable loss or damage to perishable commodities like fruits, vegetables, etc., which occurs in the normal course due to lapse of time, without the intervention of any accidental circumstance. B. The loss caused by the risk must be capable of measurement in terms of money. For example, assets like buildings, machinery, stocks, household contents, etc. are insured for their intrinsic value, i.e., economic value, current market value, or replacement value, as the case may be. Ancestral property, e.g., an antique clock which has no market value, may have sentimental value to the owner. The latter value cannot be insured. In rare cases, works of art, etc., can be insured on agreed value basis subject to valuation of experts. In liability insurance too, the loss payable is measurable in terms of money. It depends upon the amount of monetary compensation awarded at law. In personal accident insurance, the value of human life cannot be measured. Therefore, policies are issued on the basis of specific sum insured which has some reference to the earning capacity, financial status, etc. of the insured. C. The object of the contract must be legal. A professional indemnity issued to a medical practitioner protects him against claim made against him for professional negligence and not for professional misconduct or malpractice, for that would be contrary to law. A personal accident policy excludes death or disablement caused by intentional self-injury, suicide or attempted suicide, as these are offenses under the Indian Penal Code. D. The risk must not be against public policy. A motor vehicle insurance policy pays for accidental damage to the vehicle or legal liability for injuries of a pedestrian, etc. But no insurance is available to pay for fines for traffic offenses, although this may be regarded as financial loss arising out of the motor vehicle. Considerations of public policy do not allow such insurances. The term public policy may be broadly described as a set of moral and social principles or rules observance of which is recognized to be necessary in a well-ordered society. A. The risk must not be such that it may cause high catastrophic losses. For example, war and kindred risks and nuclear risks are excluded from all policies in respect of property on land because loss or damage caused by these risks is considered to be beyond the capacity of commercial insurance. Exceptions. I. Goods in transit by sea or air can be covered against war and kindred risks as catastrophic element on land risks is not present in sea or air transit. E. Nuclear and radioactive contamination risks are excluded under all policies including marine. 41. Finally, in order that an insurer can offer insurance against a particular type of risk, there needs to be large number of exposure units which are I sufficiently alike, and independently exposed to risk, to enable insurers to use past loss data to predict future loss experience, and to obtain a large stable premium portfolio not unduly exposed to an accumulation of losses from any one event. This aspect is dealt with next under the topic Theory of Probability. Theory of Probability. As explained earlier, the rate of premium is arrived at on the basis of past loss experience. Therefore, statistical data regarding past losses is most essential for purposes of fixing rates. 42. To fix rates, it is necessary to give a mathematical value to the risks. For example, if the loss experience of a large number of motorcycles is collected for a period of say 10 years, the result will indicate the sum total of the losses resulting from theft of the vehicles. If this amount of loss is expressed as percentage of the total value of motorcycles, it is possible to fix the mathematical value of the risk. This may be expressed in the formula LX100 V, where L refers to the sum total of the losses and V to the total values of the motorcycles. The following hypothetical figures are used for a simple illustration. Value of a motorcycle 50,000 rupees per. Loss experience. Out of 1,000 cycles, in say 10 years, 50 cycles are stolen. On an average, 5 motorcycles become total losses due to theft every year. Applying the formula, the result will be LX100 equals 50,000 x 5 equals 250,000 x 100 equals 0.5%. V 50,000 x 1,000 equals 50 million. Therefore, the rate of premium that a motorcycle owner pays is 0.5% of 50,000 rupees per i.e. 250 rupees per year. This is called the pure premium, which is loaded, as explained earlier, to produce the final premium of, say, Rs 0.300. 43. The mathematical value is determined by examining a large number of cases exposed to the same degree of hazard. The larger the number of cases, the better will be the ability to forecast the future losses. This is the law of large numbers. It is also called the law of average, or the doctrine of probability. According to this law, the greater the number of instances considered and longer the period examined, the more likely it is that experience will be repeated in future instances, and more reliable will be the forecast of future loss experience. 44. In the example above, it is assumed that 5 motorcycles will be total losses in a year. But this assumption is made to provide a simple illustration of how the insurance system works. But in actual situations, the number of total losses may vary from year to year. For example, in one year, the number of total losses may be 20, in another year 5, and in the third year 40. But insurers cannot collect or adjust premium after the losses occur, they have to arrive at the premium in advance to take care of losses which may occur in the future. Therefore, they have to be in a position to predict or forecast future losses as accurately as possible. This, they are able to do because of the law of probability. 45. This law, which is also called the law of large numbers, or the law of averages, provides a good basis for forecasting future events. According to this law, the greater the number of instances considered and longer the period examined, the more probable it will be that past experience will be repeated in the future. In other words, the law of probability enables the insurers to estimate or forecast future loss experience with greater reliability. In the example, loss experience of only 1,000 motorcycles over a period of 10 years was examined. If the loss experience of, say, 10,000 motorcycles was examined over a period of say 15 years, the pattern of total losses per year would probably be 20 in one year, 10 in another year, and 30 in the third year. It will be observed that there is wide fluctuation in the pattern of losses. If the number examined is increased to 1,000 in the period to 20 years, then the pattern of total losses per year would probably be 20 in one year, 15 in another year, and 25 in the third year, and so on. If the number of units examined and the period are further increased, then the loss pattern would probably be 20 in one year, 18 in another year, and 22 in the third year, and so on, resulting in a more reliable average. 46. Thus, it will be observed that with increase in the number of cases insured, the difference between the actual future losses and the estimated future losses becomes less and less. Thus, insurers are able to anticipate future losses more accurately and fix the rate of premium. This is the reason why it is said that for successful operation of the insurance business, a large number of risks should be available for insurance. 47. The requirement of a large number has dual application to estimate the underlying probability accurately. The underwriters must have a sufficiently large volume of data. The larger the sample, the more accurate will be the estimate of probability. Once the probability estimates are worked out, sufficiently large number of insurance contracts must be entered into to avoid possible losses as a result of small volumes of business. In making estimates on the basis of historical data, underwriters assume that things will continue to happen in the future as they have happened in the past. The insurance company is able to do something that the individual cannot, and that is to predict within reasonable limits the amount of losses that will actually occur. 48. Insofar as its predictions are completely accurate, the insurance company faces no possibility of losses, for it will collect from each individual a share of the total losses and expenses as they occur. If the predictions are not accurate, the premiums that the insurer has charged may be inadequate and as such the insurer would incur a loss. If, on the other hand, premiums collected are more than adequate, the insurer would make a profit. 49. The accuracy of the insurer's predictions is based on the law of large numbers. This is possible because of laws of probability which enable more accurate calculations possible when larger volumes are involved. 50. Probability theory is that body of knowledge concerned with measuring the likelihood that something will happen and making estimates on the basis of this likelihood. It deals with random events and is based on the premise that, while some events appear to be a matter of chance, they actually occur with regularity over a large number of trials, revealing a measurable pattern as it were. 51. The likelihood of an event is assigned a numerical value between 0 and 1, with those that are impossible assigned a value of 0 and those that are inevitable assigned a value of 1. Events that may or may not happen are assigned a value between 0 and 1, with higher values assigned to those estimated to have a greater likelihood or probability of occurring. In reality, events assigned 0 probability may in rare circumstances actually happen, and events assigned 1 probability may very rarely fail to happen. 52. Thus, probability is the relative frequency with which a specified event can be expected to occur in the long run. For example, in a large number of tosses, a coin can be expected to come up, heads, as often as it comes up, tails, and, of the many motor cars now on the road, insurance company statistics may indicate that 1 of every 99 can be expected to be stolen within the year. 53. Such probabilities can be expressed as fractions. The probability of a head on a coin toss can be expressed as 1/2 of 50%, or 0.50. The probability that a specified car will be stolen in the next year can be expressed as 1/99 or 1.01%. 54. The probabilities associated with coin tosses can be developed theoretically. Given a description of coins, a person who had never seen them could calculate the probability of, say, a head. Such theoretical probabilities are termed as prior to experience, or a prior. 55. In contrast, the probability that a car will be stolen within the year cannot be deduced theoretically. These probabilities must be estimated by studying a sample of cars and seeing what proportion are stolen. These probabilities, based solely on historical data, are often described as empirical or experiential probabilities and are used in the insurance business. 56. The accuracy of an empirical probability depends on the size and representativeness of the group studied in developing the estimated probability. Estimating the probability of car theft, for example, requires study of a large group of average cars and an accurate determination of how many of those under study are stolen. Studying only a small number of cars, say 100, probably would produce unreliable results. Studying only cars driven in rural areas would introduce a bias into the study, and the result probably would not be valid for average cars which are used in urban areas. 57. It must be appreciated that the law of probability is subject to the qualification that conditions remain the same. Motor losses are caused by several factors such as road conditions, traffic density, population, enforcement of traffic regulations, etc. Sudden increase in the number of vehicles and pedestrian population, deterioration of roads, laxity in the enforcement of traffic regulations, etc. may increase the number of accidents. These trends will have to be taken into account by insurers in adjusting the rate of premium suitably. Thus, fixing of premium rates not only calls for mathematical calculation based on past experience but also a great deal of judgment and foresight. 58. In tariff classes of business, the rates of premium are fixed by the Tariff Advisory Committee, which is a statutory body established under the Insurance Act, 1938, as amended, and operating under the direction and control of Insurance Regulatory and Development Authority. In this context, the provisions of Section 64(u)(c) of the Insurance Act are relevant. 1. The Advisory Committee may, from time to time and to the extent it deems expedient, control and regulate the rates, advantages, terms and conditions that may be offered by insurers in respect of any risk or any class or category of risks. And any such rates, advantages, terms and conditions shall be binding on all insurers. 2. In fixing, amending or modifying any rates, advantages, terms or conditions, relating to any risk, the advisory committee shall try to ensure, as far as possible, that there is no unfair discrimination between risks of essentially the same hazard and also that consideration is given to past and prospective loss experience. Provided that the advisory committee may, at its discretion, make suitable allowances for the degree of credibility to be assigned to the past experience, including allowances for random fluctuations, and may also, at its discretion, make suitable allowances for future fluctuations and unforeseen future contingencies, including hazards of conflagration or catastrophe or both. Note, these are basic concepts of rate making and are also applied by insurance companies in non-tariff classes of insurance. 59. The law of probability emphasizes the vital importance of statistics in insurance operations. In tariff classes of insurances, past loss experience of insurers is collected by the Tariff Advisory Committee and rates of premium are determined on the basis of the statistics thus obtained. 60. If no statistical experience is available, the level of premium, of necessity, has to be estimated in the first instance and, subsequently revised from time to time in the light of loss experience. 61. Unlike life insurance, general insurance presents difficulties in determining the mathematical value of risks, as it is not always possible to obtain experience of a very large number of similar cases exposed to the same hazard. 62. Nevertheless, measurement of risks is most important for successful transaction of insurance operations. Within the limitations set by the nature of the risks, insurers endeavor to ensure that rates of premium are fixed in as scientific and equitable a manner as is possible. The insurance system. 63. Three important elements are involved in the concept of insurance. Firstly, there is the subject matter of insurance, which may be human life exposed to death or disablement due to accident, or property such as buildings, machinery, goods, merchandise, motor vehicles, ships, etc., exposed to loss or damage. Secondly, the peril which may cause the loss or damage. Examples of perils are fire, burglary, storm, earthquake, explosion, accidental bodily injury, etc. Thirdly, the financial loss which results from the damage or destruction of the subject matter. 64. The object of insurance is, therefore, to provide protection against financial losses caused by fortuitous events. In other words, insurance is a protection against the consequences of risk. The risk of an individual insured is transferred to the insurance company, which spreads the risk over a group of all insureds who have also transferred their risks to the insurance company. The concept is, few insureds who suffer losses are paid out of the premiums paid by the many. Thus, spreading of risks or pooling of risks is the basis of insurance operations. 65. Insurance companies apply broad principles and adopt specific practices to conduct the business along sound scientific lines to produce a reasonable profit on the operations. This is known as underwriting. The ultimate underwriting objectives are to produce a well-spread and a large volume of premium income and to ensure the quality of insurance business through careful selection of risks for acceptance, proper rating, etc. And eventually through control over claims processing. To achieve these objectives, some of the approaches adopted are as follows. Insurers are incorporated as a public limited company so that with larger capital resources, they are able to write larger volumes of business and thereby achieve a larger spread of risks. The need for large volume of premium income is self-evident. However, there is need for wide and judicious distribution of insurance business class-wise and area-wise, to allow for the operation of the law of large numbers. Insurers seek to write business in all classes of insurance, fire, marine, motor, etc. Even in each class of insurance, they achieve spread by accepting risks in different subclasses, e.g. residences, shops, godowns, manufacturing risks, etc. It is not likely that all classes of insurance will produce losses at the same time. When one class of business produces losses, another class may yield profits. Similarly, insurers write business in different geographical areas within the country and also in different countries. Indian insurers operate also in overseas markets. This is geographical spreading of risks. If one territory shows losses, another may produce profits. Insurers resort to reinsurance, which is a system used by insurers to spread among other insurers the risks they have undertaken in insurance contracts. Reinsurance is an arrangement whereby an insurer, who has accepted an insurance, transfers a part of the risk to another insurer so that his share of a heavy loss is reduced. For example, if insurance is granted on a large petrochemical complex where the loss potential may be in crores, part of the risk, i.e. a certain percentage, is reinsured with other insurance companies in India and abroad. Again, insurers also accept reinsurance business from other companies. It is evident that reinsurance is an extension of the basic concept of insurance system, i.e. to spread the losses of the few over the many.